Most people still believe that blockchain and crypto are mainly about price speculation, internet hype, and risky experiments. From the outside, it looks chaotic, unstable, and immature. But while the public focuses on market swings and headlines, something far more important is happening quietly in the background. The world's largest financial institutions are steadily building the foundations of an entirely new financial system, on-chain. This transition is not loud or dramatic. Banks do not announce revolutions. They move cautiously, test systems privately, and adopt change only when it gives them a clear advantage. The silent institutional shift. Institutional finance moves differently than retail markets. Before any new system becomes visible to the public, it goes through years of internal testing, pilot programs, regulatory discussions, and limited deployments. Right now, banks, asset managers, and financial infrastructure providers are using blockchain technology to settle transactions, record ownership, and move value more efficiently. These systems are often invisible to everyday users because they operate behind the scenes. Instead of flashy apps or public announcements, institutions focus on settlement layers, custody solutions, and compliance-ready blockchains. The goal's not disruption for its own sake, but reliability, cost reduction, and speed. Blockchain allows transactions that once took days to settle to be completed in minutes, sometimes seconds, with fewer intermediaries and less operational risk. Why blockchain makes sense for institutions? Institutions are not driven by ideology. They are driven by efficiency, security, and risk management. Blockchain technology solves several long-standing problems in traditional finance. It creates a shared ledger where all participants see the same data, eliminating constant reconciliation between separate systems. It reduces settlement delays, which lowers counterparty risk. It provides transparency and traceability, which are critical for audits and compliance. From an institutional perspective, blockchain is not revolutionary or dangerous. It is simply better infrastructure. Just as the internet replaced fax machines and paper communication, on-chain systems are slowly replacing outdated financial rails that were designed decades ago for a slower world. Tokenization, the core building block. The most important part of this transition is not cryptocurrencies. It is tokenization. Tokenization means representing real-world financial assets as digital tokens on a blockchain. These tokens can represent ownership in bonds, funds, real estate, commodities, or other traditional assets. Institutions are already tokenizing government bonds, money market funds, and private credit. This allows assets to be traded, settled, and managed digitally with far greater flexibility. Tokenized assets can be transferred instantly, split into smaller units, and integrated into automated financial systems. What used to be locked behind paperwork and restricted access becomes programmable and global. This is how finance slowly turns into software. Regulation didn't stop this. It enabled it. Many people assume that regulation slowed down blockchain adoption. In reality, regulation shaped it. Institutions waited until legal frameworks, custody standards, and compliance tools were mature enough to support large amounts of capital. Once those pieces were in place, adoption accelerated. Today, on-chain systems are being designed to work with identity checks, reporting requirements, and regulatory oversight. This makes them usable for institutions that manage billions or trillions of dollars. The result is a financial system that keeps its legal structure while upgrading its technical foundation. Why this is happening so quietly? There is a reason you don't hear much about this shift in the news. Public attention creates volatility and risk, and institutions avoid both. Building quietly allows them to test systems without pressure, avoid market speculation, and gain experience before competitors and the general public catch on. By the time on-chain finance becomes a mainstream topic, the infrastructure will already exist. The learning curve will be steep for late adopters, while early learners will move naturally within the system. What this means for you. You do not need institutional money to start understanding on-chain finance. While banks build at scale, individuals can build knowledge. Learning how wallets work, how tokenized assets represent ownership, and how on-chain settlement differs from traditional systems gives you a massive, long-term advantage. This is not about day trading or chasing trends. It is about familiarity. Every major financial shift rewards those who understand the system before it becomes mandatory. The people who learned online banking early did not become rich overnight, but they were never confused when the world moved digital. The cost of waiting. Every financial transition creates two groups: early learners and late adopters. Late adopters usually enter when systems are mature, regulated, and widely accepted, but also when the easiest advantages are gone. They pay higher cost, face steeper learning curves, and depend more on intermediaries. On-chain finance is following the same pattern as the internet, digital payments, and online investing. Waiting for full mainstream adoption does not eliminate risk. It only delays understanding. The on-chain financial system is not a future prediction. It is a present-day construction project, being carried out quietly by the institutions that shape global finance. You do not need to compete with them, and you do not need insider access. You only need awareness, education, and time. The biggest advantage in any financial system is not capital, it is familiarity. Institutions are already building on-chain. Learning the system now means you won't be lost later.